The Economist, whom we have been waiting to hear, ultimately fiscal deficit and its exponential rise was what has run down and created so many problems for us. Jahangir Aziz, chief economist, JPMorgan, joins in. Good morning, Jahangir. Thanks much. What is your expectation in terms of the big numbers? What would be a good, realistic tax revenue growth number to assume? The VOA gave a 21% tax revenue projection. And what is achievable and a good deficit number?
I would say that, as far as, there's just 6 months left for for this year's budget. And I think that trying to keep it as close as possible to the interim budget would probably be the right thing to do. I'm not saying it has to be exactly 4.1, but 4.2, 4.3, I think we would take it away as a good thing to happen. I think I agree with you that the 21% growth rate is, way too optimistic. And so therefore there has to be some rationalization on how much tax revenue will come in through. But having said all of that, I think, the equity market has created the space for the government to actually tone down the expectations from tax revenue and increase the non-tax revenue, even if they do not change the volume of privatization. Just the price action over the last 3-4 months has given them at least 0.3, 0.4% of GDP of additional space. Add to that the fact that the rupee has appreciated since the interim budget, which means that whatever calculations they had on the oil subsidy must necessarily be lower today than during the interim budget. So I think there is space. Hopefully they will not misuse it.
Well, yes, that is the eternal hope. Jahangir, good morning. The borrowing figure is being watched for very closely. Do you think that 5.97 lakh crore number will be changed? And if it is scaled up, how will the markets react to it?
My guess is that they will try to keep it as close as possible to that number without making any changes, which means that one has to watch very carefully as to what the privatization number is. So because I think that's where most of the action is going to take place. That they will most likely come up with a much larger privatization projection than the interim budget, and that's where the devil will be in the details. And to what extent the market remains at these elevated levels for the next 6 months for the government to actually acquire that kind of revenue. So I'm not too worried about the borrowing number. I think they will stick to the borrowing number. They will basically play around with the privatization number.
Okay. Revenue deficit, we all speak only about the fiscal deficit, and the 4.1 and the 4.5 is etched in our minds. But revenue deficit has, in the last 5 years, among the worst things that the UPA government did to us, 75% or 70% of the total deficit is actually a revenue deficit. Will you watch that number? And if that came in again at about 3.2% revenue deficit, will you give them an A- or a C-?
Look, I would look at it overall. I don't think that in the next 6 months, they have very much room to play around with the number. We will have to wait for that number or look at it carefully in the full year budget when they have time to actually do the tax administrative changes and tax policy changes, etc. But on your point, I think, if they do manage, let's say, to make it to 4.1 or 4.2 and keep the overall fiscal deficit the same, but with a higher amount of privatization, that would necessarily mean that the underlying fiscal stance of the economy, of the government is looser than before, which means that they're again pump-priming the economy, and at 8% core inflation, pump-priming this economy is going to be a pretty bad idea and tie down RBI's hands very much.
Okay. And you think foreign investors will see through this if they see this fiscal deficit being achieved only because of disinvestment and not because of really earning more than you were and spending less than you were? You think foreign investors will see through it? Is that the conversation you're getting from them?
Almost definitely, because that's the way in which all other countries do their budget. No one really puts privatization receipts on top of the line. They all use it as a financing item. So almost every foreign investor who has worked on some other country will almost necessarily take out the assets sales part of it, look at the budget deficit net of asset sales, and that's what they compare in terms of what happened last year, what happened this year, in terms of trying to gauge whether the fiscal stance is easier or tighter than before.
I missed the divestment target number. I don't know if you've mentioned it, because most are expecting it to be scaled up aggressively, this time around. What are you going in with, and how will the markets react?
We are looking at almost close to 0.8% of GDP of divestment number in the revised budget, because that's really the only way in which they can manage to keep close to the 4.1, 4.2 target, give a bit more of spending on the capital on the infrastructure front, because that's really what everybody's expecting for. And if they don't do that, the market will clearly be very disappointed, as they were with the railway budget. So I think they will give 0.1, 0.2% of additional capital spending. And Vinayak, I have a huge respect for his views, but Vinayak talked about all these off-budget financing, plans to finance infrastructure, to ease infrastructure, etc. That's a pretty bad idea. No one really, the overall fiscal deficit is overall fiscal deficit. You can play around with, off-budget items. The previous government did quite a bit. If you remember the, old days when they used to have these oil bonds, etc. But at the end of the day, it's bad for the economy if that's the way they're going to go and find financing for infrastructure, and not through the budget.
But finally, kind of out-of-the-box question, or at least I'm expecting an out-of-the-box answer. What will you, in terms of growth, in terms of, the economic magic, the next level of reform, what is the one or two things that you can expect from this budget?
So I think, a lot of people have read into this budget as being the one place where the new government, after, 6 weeks in power, will finally deliver their vision for the future. But remember, this is basically what Ministry of Finance can do. So a lot of things that people are expecting are actually outside the purview of the Ministry of Finance. So as far as the Ministry of Finance is concerned and what they can deliver, I would just look at three things. First, I would look at what they're planning to do on the fiscal consolidation part that the Kelkar committee had actually put down. So in other words, are they planning to meet 3% of GDP fiscal target next year? So that's the first thing. The second thing I would look for is what is in their purview, which is what are they going to do with PSU banks' recapitalization? That's a very big question, and that needs funding. How will they figure that out? And I would say at least some kind of a timeline on GST. I mean, look, this has been hanging around, for 10 years now. And, everybody looks at GST and says, okay, that's a revenue earner and that's a tax efficiency. But in reality, nationwide GST provides India for the first time with a uniform market. India doesn't have a uniform consumer market.
All right, Jahangir, fair enough. Thanks for joining us.